everyone. I am Liam Burke, Managing Director with B.Riley Securities, and I'd like to welcome you to Capital Link Shipping Sector's webinar series. In this series, we have an opportunity to delve into the latest trends, challenges, and opportunities shaping the shipping sector. Today's webinar is on the LNG shipping market. We have with us Mr. Jerry Kalogiratos, CEO of Capital Product Partners LP, Mr. Richard Tyrrell, CEO of Cool Company Limited, Mr. Karl Fredrik Staubo, CEO of Golar LNG. The opening slide contains information to which each company is listed and their ticker symbols. The webinar will consist of a roundtable discussion with the moderator and panelists. It will last for about an hour, with about 45 minutes allotted to the panel discussion, followed by a 15-minute or so Q&A session. Participants can submit their questions through a Q&A button on your screen during the webinar. Your questions will be answered during the Q&A session. Please note, Capital Link will be conducting 3 polls during the webinar that will strictly be used for informational and educational purposes. We would appreciate your participation in answering these poll questions. Before we begin our call, please note this discussion is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. In terms of further disclosure, Capital Link is the investor relations advisor to some of the companies participating in the webinar. Also, B.Riley Securities. At B.Riley Securities, I cover all of the shipping companies included in today's webinar. With all that behind us, we can now start our discussion. And just as a reminder, we will, after the panel discussion, have the polling questions brought up. Anyway, to start out, all of your businesses add to the global fungibility of natural gas, either through LNG transport or LNG production and liquefaction. Looking at natural gas, and particularly LNG, it is sometimes viewed as a transitionary or fuel in order to buy time for the build out of the infrastructure of renewables like offshore wind and solar, or as a more environmental friendly alternative to coal. Is natural gas and derivative LNG a transitionary type of fuel, or is it actually a long-term, economical, environmentally friendly fuel solution for the long term? With that long overview, if we could start with Karl on your thoughts on that.
Hi, and thanks everyone for dialing in here. I think the question is, how long is medium term and long term? I think over the very long term, everything is transitional the way we see it. But I believe that LNG has a vital role to play going forward. Today, LNG comprises of around 3% of the global energy mix, and including natural gas, 24%. In fact, LNG and natural gas is estimated to be the second fastest growing source of energy between now and 2030, only beaten by renewables. Natural gas and LNG's market share is expected to then grow from 24 to 29% of the global energy mix, and specifically LNG from around 3 to 5% of the global energy mix. In fact, LNG is an enabler of renewables in several locations, because when you do not have wind, sun, or rain 24/7, 365, you are reliant on a flexible backup source of energy, and their natural gas is unique in its attributes that you can very quickly turn on and off a gas-fired power plant with far less emissions than if you try to do the same with an oil-fueled or coal-fueled power plant. And as we all know, nuclear power plants have not yet been able to be turned off and on again without a cost in sort of several $100 million. So subject to how long the definition of medium and long term, I believe that LNG has a vital role to play for a very long time. And I think its role is increasing in terms of importance, and it enables a greener energy future.
Jerry, do you have any color to add to that? Thank you, Karl.
No, I fully agree with Karl. In the end, I think when it comes to tackling climate change, we are all for adopting realistic solutions as soon as possible, and LNG has been singled out one of these sources of energy that can deliver significant reductions in emissions. And at the same time, and this is not something that we should not underestimate, it also delivers better air quality in big cities. So I think demand for LNG is expected to continue to grow quite robust over the next 20 years or so. As Karl pointed out, it's the issue of intermittency when it comes to renewables, but it's also the obviously the adoption of less clean source of energy like coal, and we have seen that across a number of countries. But in the end, natural gas, and specifically also LNG, and its infrastructure can play a role even in a decarbonized world through carbon capture or as a hydrogen carrier through the ELNG venue. So I think that both natural gas and LNG will continue to be very much in demand as we move towards decarbonization. But also assets that are related to natural gas and LNG, such as pipelines, vessels, will also play a significant role even as we move away from hydrocarbons. So the decarbonization does not necessarily mean that we will move away from the way we do business today.
Richard, any other final thoughts on this topic?
Yeah, sure. Thanks, guys, and thanks, Liam. This is Richard. I'm the CEO of CLCO, and we're a LNG shipping company. So naturally, we think about the LNG value chain all the time. And I think in general, an overarching comment is that I think capital is being quite badly misallocated in the race to tackle climate change, and LNG can do more in the short to medium term than a lot of alternatives that are currently proposed. The amount of coal that's being burnt in China and India is an outcome of a lot of LNG going to Europe at the moment, and the result of that is 50% greater emissions. Thankfully, I think that the growth in LNG capacity will see more volumes going east going forward, which will create greater demand for shipping. And more importantly, in many ways, see CO2 emissions coming down as a result. Longer term, do we see LNG having a continuing role? Yeah, absolutely, we do. It can meet peak demand in partnership with renewables, and we see an increasing uptake in shipping and long-distance trucking as well. LNG and renewables are set to be complementary in our view, with the ultimate need for LNG dependent on the need for storage, peakers, and energy security. Our responsibility is to make the shipping element of the value chain as efficient as possible, and that's what we aim to do.
Thank you, Richard. If we can zero in on certain markets, Europe has become one of the largest, or the largest importer of LNG. Obviously, the Ukraine conflict has curtailed Russia pipeline natural gas imports. There have been offsets, usually mild weather, plus stepped up pipeline exports for both Algeria and Norway. But what are the dynamics for sustained demand for natural gas? And of course, LNG is a major part of that in Europe. If we could start with Jerry on that. Jerry?
Sorry, unmuting. So Yeah, thank you, Liam. This is really an interesting question. And I think the global energy crisis that was set off by the Russian-Ukraine war reminded us about the critical importance of energy security and what happens if we don't pay enough attention. Europe has been effectively in hibernation when it came to its dependence on Russian natural gas, pipeline gas, and there was a rude awakening when the war started. Effectively, LNG came to the rescue, and it has played a crucial role in bolstering energy security and delivering, of course, energy over the last couple of years to European consumers. This is because LNG is a very flexible means of transporting energy, natural gas, and went on to replace the Russian pipeline gas by importing almost 66% more in terms of LNG last year. Importantly, also, we have seen a number of European markets, including Germany, Netherlands, Finland, France, Italy, having initiated plans for LNG infrastructure. This includes 26 projects with a combined regasification capacity of 104 MTPA. Importantly, also, a lot of that capacity is coming in floating terminals, which can be deployed faster than onshore terminals. And many of them have been already commissioned, bringing in this much needed ability for Europe to import natural gas in the form of LNG. So overall, I do think that the European Union and the Europe as a whole, having now seen both the risks of long-term dependency on pipeline gas, but also the flexibility that LNG brings to energy security and independence. I expect LNG imports to become a permanent staple of the European energy mix, and that even if the Russia-Ukraine war was to end tomorrow, it is highly unlikely that we will go back to the pipeline business as we knew it. I think the floating pipelines, that is LNG carriers and regasification units, have proved to be much more cost-effective and agile in situations like the ones that we're experiencing today.
Okay, Richard, can I ask a similar question on China? It is the second largest importer of LNG, very important market. Could you help us out on some of the longer-term dynamics there?
Sure, and I think China is the area where there's huge potential for LNG, and it's going to be where a lot of the growth in supply is going to be heading, because I think on the whole, while LNG has been a savior for Europe, Europe is adequately supplied now. There's a little bit less pull from the electricity space or sector because of the French nuclears being power being up and running again. Maybe industry will come back a bit in Europe, but generally, I think it's adequately supplied. However, China is the area which gave up its volumes in order to send the recent volumes to Europe, and it's got the regas capacity. I think it's just a bit price sensitive, and in addition, in China, of course, environmental considerations are a driver. However, it's a little bit different to how they're a driver in Europe, and maybe they're a little bit more focused on getting rid of soot in the air than reducing CO2. But ultimately, there will be pull from China at the right price. And if you look at where prices are heading, I think we're getting there. So I guess in summary, I do expect to see some price elasticity of demand, and it's going to be a good thing for shipping because of the distances involved.
Right. Karl, we wrap up the topic on markets. If you have anything to add to China or Europe, be great. But I think that the question I want to ask you is, do you see any other regions in the market with the growth potential that we're seeing in either Europe or China?
Yeah, I think my colleagues here covered all of the big trends. What I would say, just to finish up on the previous topic, is we're impressed to see the adaptability of Europe. Pre the Ukraine situation, we had 3 FSRUs across Europe. We then, in less than 6 months, another 9 FSRUs were tied up as import terminals in Europe. Not all of them are operational yet, but LNG import capacity is no longer a constraint to service the European LNG consumption. So that was a very remarkable turnaround, and I think the quickest deployment of FSRUs the world has ever seen. So that was one to note. When it comes to China, if you look at numbers from Rystad Energy, the world LNG market will grow from currently around 400 million tons to around 690 million tons by 2035. So that's a 290 million tons increase, and 250 of those are estimated to come out of China. So that further backs up Richard's story about where most of the incremental consumption will be directed. However, we see several other countries in Asia being increasingly important. You have India, Bangladesh, Vietnam, and other places that could see increased LNG demand. What we do see for the Far East in general is that they seem to be far more price sensitive compared to, for example, Europe. And by price sensitivity, it's the relative price of LNG as a source of energy versus alternatives, even if the alternatives is more polluting, like coal, oil, diesel, and so forth. So what you saw during the Ukraine situation was that Europe was actually redirecting all of the cargoes that went on long-term offtakes, where the Chinese were off-takers of American gas. And you saw that gas or LNG then redirected into Europe, and then coal consumption in China going through the roof. So interestingly, it was actually mainly Chinese off-takers that made the majority of the uplift, and not the American LNG suppliers, because it's obviously going to the Chinese intermediary. So where we see it is that the trend is obviously increased production, mainly out of Qatar and the US. Most of it is going to China, but there are several other countries in the Far East that also see remarkable year-on-year growth numbers. And what this is really about is the relative price of LNG in addition to the environmental benefits.
Great. Thank you, Karl. We're going to move into more company specific, and we're going to start with the carriers. So it'll be Jerry and Richard, and then we'll start talking about the FLNG in a moment. But we're looking at potentially a lot of delays in the LNG production side, while we're seeing more vessels being delivered into the global fleet. And admittedly, this is the near-term dislocation, but there's going to probably be excess fleet supply globally, probably through the end of 2025. Starting with Jerry, could you share with us how your fleet is positioned, not only through this period of excess supply, but coming out of this in the 26 timeframe, when the supply-demand equation will not equalize or even flip?
So we only have very limited exposure in the market in the next couple of years. All of our vessels that are due for delivery in 2024, that's another 4 vessels. They are fixed to long-term contracts at attractive rates. And really, our first open vessel is not before the first quarter of 2026. This is followed by another 3 new builds. So we have a total of 4 new building ships that will be coming up for delivery and employment in 2026, and another 2 in the first quarter of 2027. I would also add here that we have another vessel that has been delivered at the end of October of this year that is on a very lucrative 3-year charter, and she's also to be redelivered in the fourth quarter of 2026. So all in all, we have effectively 7 vessels coming up for employment between the first quarter of 2026 and the first quarter of 2027. And I think we are quite happy with this exposure. As you know, this is the time that between 2026 and 2028 that we see a number of the new liquefaction projects coming online. And by engaging with liquefaction operators, utility companies, energy majors, and the likes, I think this is going to be a very busy period with many of these players coming to the market with multi-vessel inquiries. So while I do agree with you that in terms of new projects, the period between 2024 and 2026 is quite muted, I would still say that one should be cautious before calling this a softer market for many reasons. Of course, there is the technology differentials, and as ETS kicks in, especially steam ships will be penalized, and many charters, as some of the steam turbine vessels are coming off charter, they will be seeking to replace them with modern 2-stroke vessels. But even if you set this aside, overall LNG fleet utilization remains quite high, and it doesn't take much for the market to move very quickly upwards. I think in Europe and Asia, we have been quite fortunate as far as energy prices, at least, and energy security, to experience fairly mild winters. But I think cold spells that are not accounted for in Europe or the Asia Pacific region, other disruptions in energy markets. Just a month and a half ago, we were discussing about potential industrial action in liquefaction in Australia. All this could very quickly move fleet utilization higher, and charter rates soaring. So I think overall LNG shipping is in a good spot, and especially for the 2026 onwards period, where we happen to have most of our new exposure, if you want. I think we are quite bullish.
Richard?
Yeah, for us, we've got everything from a ship which is currently in the spot market all the way through to a ship which delivers in 10 years' time with an average contract length of over 4 years. So we do have to think about the nearer term, and I think I'd say a few things. Firstly, we've talked a little bit about the new supply having to go further, and just to put that into context, supply to Europe typically takes 1 ship per million tons of LNG. The same volumes to China, if they're going via the Panama Canal, will take 2 ships. And if the Panama Canal limitations persist, then it'll be 3 ships. So these are big incremental changes in capacity, and we view that as being something that will certainly support the market. The other aspect, which I think is important to appreciate, is that the cost of new builds has been going up quite significantly recently. And this compares with the last decade, when the cost of new builds would go down every single year for a better and better ship. Now, the cost of new builds is going up and up and up for the same ship. So it's up over 30% over the last few years, and that very much anchors prices, especially when you combine that increase in cost with the increase in financing cost. Yeah, we now see that the clearing rate for a new build ship is plus or minus $100,000 a day, and the other ships tend to trade at a discount to that based on their size and efficiency. And we don't really see that changing. The last point, which I think, and this is where the balancing comes in, is, as Jerry mentioned, it's the steamships. It's partly because of CII, but I think it's even more so because of commercial aspects. And these were vessels that were given an extra lease of life, quite frankly, over the war in the Ukraine, because the industry needed the extra capacity at short notice. Going forward, we're going to see those ships and other ships which are coming off their long-term contracts either idled or leave the market altogether. And this will be what balances the supply demand, which you referred to in your question, Liam.
Well, yeah, you bring up some good points about the age of the fleet, Panama Canal. And the fact is, coming out of this, when production does ramp up, and we'll call it 2026, you're in not only good shape for that, but also getting through that period of what looks to be less tight supply, put it that way. Flipping over to you, Karl. LNG production 23 and 24 has been muted. You've secured very attractive charters for your two FLNGs. How does the your thoughts on production increases in 26 and 27 affect your decisions on the rechartering of Hilli in 2026 and the launch of your next FLNG, Mark II FLNG?
Thanks, Liam. That's an interesting discussion to have around that. So if you take supply meant to come on between 2025 and 2027, we're looking at just around 90 million tons of LNG to be added to the market. The driver here is really the US, who's adding around 62 million tons alone. Then you have around 12 million tons from Qatar, and then 19 million tons from elsewhere. As we alluded to earlier in the call, there's a very strong demand for that LNG. So we do think that there's plenty of capacity to further increase that. Where we see our uniqueness is that we're mainly focused on West Africa and monetizing associated or stranded gas fields. On the supply side of LNG, you basically have three cost drivers: the cost of lifting the gas, the cost of liquefying the gas, and the cost of transporting the gas. Hence, if you're in West Africa, we argue that you can produce associated or stranded gas significantly cheaper than Henry Hub, which is the input cost for the US export projects. We have a capex per ton, which is around half of what you can build shore-based liquefaction plants for in the US today. And lastly, the shipping distance from West Africa, both to end users in the Far East and in Europe, is far shorter than that of the US, which is the biggest incremental producer then of LNG. Hence, if you have a business with three cost drivers, and you're significantly cheaper on all three counts, then we think that's a very attractive position to be in. Specifically when it comes to Hilli and further growth FLNG projects that we might undertake, Golar is currently the only service provider of FLNG as a service in the world today. And if you go and order an FLNG today, there's no way she'll be delivered and operational during second half of 26, which is when Hilli is up for recontracting. So if you are a government or a gas resource owner, whether that's an IOC, an NOC, or an independent gas company, the only way, the only tool in the world available to monetize your asset is Hilli. and she's then again available from July 26. So if there are anyone dialing in who have those resources, we are actively working to redeploy now, and that's our focus. And also how we see the growth. We think going forward, the world needs, I think we learned the hard way that it's helpful to be diversified in your energy sources. And when Qatar and US are really the two only ones adding significant volumes, we think the world will do itself a service by further diversifying such sources, both from a security but equally important cost point of view, which is why we think that we should get going on monetizing the more than $100 billion of 100 billion barrel of oil equivalent of stranded gas reserves, proven stranded gas reserves in West Africa.
Great, thank you, Karl. Richard, can we just touch on you mentioned the Panama Canal. I just want to broaden the discussion of what's going on in the Red Sea and the Suez Canal. The length of this uncertainty, I mean, is this something you can count on for a long time, or it just seems that congestion is going to increase, and it's not just in the Panama Canal. It seems to be with unrest throughout the rest of the world.
Yeah, gosh, well, I wish I could forecast the weather and geopolitics. I'm not sure I can.
Fun. Just the weather.
Just the weather would be fine. I guess, let's put it into context, right? I mean, if a ship is going to go from the Gulf of Mexico to the east through the Panama Canal, it will take about 28 days. If it's going to go around the Cape of Good Hope, which is actually going around in the other direction, that's down in South Africa, then it will take about 41 days. And the incremental days on a round trip basis, therefore, is about 26 days. And this is why you go from 2 ships to 3 ships under that scenario. Now, how long will it last? Well, in the case of the Panama Canal, they are waiting now for the rainy season fundamentally, and that's not due to come until May. Whether it comes and in what sort of volumes will depend upon El Nino and all sorts of very, very difficult to predict type of factors. So, well, we really will have to see, but that's a big swing factor in the industry, as is the Suez Canal to some extent as well, because that will bung up shipping, and generally these things has a positive overall effect.
Thanks, Richard. Jerry, if you have anything to add before we move to the next question on the congestion issue.
Yeah, sure. The Panama Canal, obviously, closure or partial closure could be overall big for certain kinds of shipping. LNG vessels and LNG operate for some time, and as a result, we have seen that many charters would avoid the Panama Canal in any case, even before this issue arose. The Panama Canal authorities would typically allocate 2 to 3 transits of LNG vessels per day. This could be reduced further to 1 or 0, who knows. But overall, because of the fact that the Panama Canal has been unreliable in terms of the waiting days, and secondly, because also we have seen a lot of US liquefaction operators exporting LNG to Europe, thus there was no obvious need to go through the Panama Canal. I think the LNG industry will probably be less affected than others because of the Panama Canal disruptions. But overall, I think any type of disruption that generates ton mile could be beneficial for fleet utilization, of course, charter rates.
Great, thank you. All three of your businesses generate very predictable revenues and cash flows. Look at the dividend yields. Both Golar and CPLP's yield around 4.5%. CLCO's is north of 14% on dividend yield. But beginning with Karl, could you discuss capital allocation, not only in terms of your dividend payout, but in the broader scheme of your fleet management and shareholder allocation?
Yeah, so one thing is dividend yield, but we have an equally big buyback program. So if you look at, for now, we're paying 25 cents a quarter. We have 105 million shares outstanding. So per year, we're paying $105 million. Earlier this year, we put in place a buyback program of $150 million. And based on a press release we pushed out last week, we've spent just over 60 of that. So if you look at total return to shareholder, it's more than just the yield. The reason why we've decided to do it that way is because we deem the share price to be very attractive, currently trading around book value, and we think that we've created significantly more value than book. When it comes to capital allocation altogether, our ambition is to return operating cash flow to shareholders. We then have around $1 billion of cash on the balance sheet, and we're planning to use that for attractive FLNG growth projects. That's really, quite simplistically put, our capital allocation idea.
More straightforward. Jerry, you've been very busy on the fleet front, so I'll turn it to you.
Thank you, Liam. So as far as we are concerned, we recently announced the acquisition of 11 new LNG carriers. That's an acquisition valued at $3.1 billion. The vessels start to deliver from as soon as we close our equity raise, that is in a week or so, and then throughout 2024, 2026, and 2027. Once this acquisition is completed, we will own a fleet of 18 two-stroke LNG carriers with an average fleet age of 3.2 years, a very modern fleet with contracted revenues from the LNG fleet alone of $2.5 billion and 6.5 years of remaining charter duration. The pro forma EBITDA of the combined fleet, that is the LNG carriers, and if you want the legacy fleet of the 15 container vessels that we have, will be to the north of $600 million, with potential for free cash flow per year of close to $150 million after debt service. Currently, in order to finance this acquisition, we are doing a rights offering of $500 million, $500 million, which is fully backstopped. And we, as I said, that we expect to close this this week. And in addition to that, there is a vendor's credit of $225 million that, together with cash from the balance sheet and first lien debt, will finance the acquisition. What we have said is, obviously, we are in a growth mode right now, and we have not changed our distribution policy, which remains firmly in the 60 cents per unit per year. But what we have said is that in the coming quarters, our board will revisit the distribution, the dividend policy, and potentially have this more linked to free cash flow generation going forward. So we expect that once we complete this very important transaction, we will be able to give more visibility with regard to the distribution policy, but importantly, the company in terms of both its fleet footprint, but definitely also its cash flow generation footprint is expected to grow significantly over the next 2.5 years.
Great. Thank you, Jerry. And Richard, just to wrap it up.
Yeah, for us, dividend yield is an important part of our story. We're fully funded, and that includes the 2 new builds, which are delivering at the end of next year. The policy we've got is very simple, really. It's to distribute the free cash flow to equity after certain investments in the existing fleet, such as dry docks, and that's how we see it. Right now, as you mentioned, it's I think a 14% yield as at today's share price.
Thank you. We only have a few minutes left. I think the easiest thing to do is we've covered quite a few things from the macro down to some of the more company-specific discussion. Any final thoughts? As we can start with Karl, Jerry, and then Richard on anything that we haven't covered.
I think we have covered quite a lot, but I think our closing remarks is that we should enable and continue to diversify our sources of LNG. In the view of ESG and in particular the S in ESG, we think it's only right to develop Africa through monetization of natural resources that will benefit them both economically and getting access to their own sources of energy. And Golar remains highly committed to continue to expand our fleet of FLNGs. And we have taken very significant steps in ordering our potential 3rd unit, with committing more than $400 million into long lead items and securing a ownership. So that's where Golar is right now. We're also just about to see startup of our 2nd FLNG on the Greater Tortue area offshore Mauritania, Senegal, under a 20-year contract for BP. So I think we are just about to double our operating fleet and are looking for our 3rd unit. So we are looking very optimistic about the future.
Thank you, Karl. Jerry?
I believe that with the recently announced acquisition, we demonstrate that we believe that the LNG shipping industry is where we want to be. Once all ships are delivered, we will have a fleet of brand new 18 LNG carriers, which currently is the largest 2-stroke fleet listed in the US. We hope that through adept commercial management, the very nice portfolio of charters that we have with staggered expirations and very good quality counterparties ranging from energy majors to utilities, and also our right of first refusal that we have on a number of energy transition vessels, such as very large ammonia carriers as well as liquid CO2 carriers. We can become a bellwether not just for LNG shipping, but for energy transition shipping in general. We do believe that, as we discussed at the outset, LNG is going to play a major role in the energy transition together with other sources of energy. But also over time, as I said at the beginning, LNG infrastructure assets, including LNG carriers, are expected to play, in our mind, a significant role in a decarbonized world, carrying biomethane, ELNG, or other types of decarbonized hydrocarbons potentially as a carrier for hydrogen. So overall, we are quite confident that the LNG industry will, and of course LNG shipping will play a major role in energy transition.
Thank you, Jerry. And Richard, your final word?
Yeah, for me, I'd watch out for where LNG is going and the distances involved. I'd watch out for choke points such as the Panama Canal, as discussed. And then lastly, and not as yet discussed, but I'd watch out for where the forthcoming Russian volumes are going as well.
Great. Well, thank you. That times out just perfectly. We're going to go to our survey right now, and we'll put that up before we open it up to Q&A. So if we want to do that, you'll see the survey appear. We have 3 questions, and we'll get the results, and then we can go right to Q&A. Okay. All right. Give it another minute, and then we'll jump into Q&A.
But Liam, you can speak in the meantime if you have any questions to.
I've got quite a few if I get going. Oh, there are the results. There we go. Okay. All righty. And let's jump into Q&A now. Everybody has seen the...
So before you go into the Q&A, you've done a great job as panelists. People are more bullish now after listening to your great insight. That's Nicholas.
All right, we'll start with, I guess this is Karl. How many FLNGs do you see online in 5 years? And how many of those do you think Golar will be owning?
Well, the world today has 8 FLNGs. That's 2 from Golar, 2 Eni, 2 Petronas, 1 Shell, and 1 New Fortress Energy. I think in the next 5 years, we should see probably around 15 FLNGs, and our ambition is to double the fleet, so at least 4 ships by that time. You mean online, like fixed and delivered, producing? Yes.
Right, producing.
Yeah.
How long do you see LNG replaced by hydrogen, and can the LNG infrastructure also service hydrogen shipping? I'll throw it out there.
Happy to take it.
You're great.
It'll take some time. And then there's going to be a question over, what vector are you going to use to transport the hydrogen? And some people are even thinking about using methane and LNG as the vector, and then breaking out the hydrogen at the destination, with carbon black being the byproduct, which is quite an interesting thought. Then you've got ammonia, which is another vector which has certain advantages in terms of its not relative density compared to LNG, but it's got good energy density compared to hydrogen. And then you've got the transportation of hydrogen itself, which is quite challenging for various reasons. I mean, I guess most fundamentally because the molecule is tiny and it can escape through most things. So we'll have to see. But I think in the near term, LNG isn't actually a bad choice, particularly when you think that it reduces emissions by 50% versus coal.
Thank you. I have a sort of a tangential question, but I'm interested to hear the answer. So, I mean, you all are tangentially involved in this. I know Golar actually did operate FSRUs, so they sold them. But the question is, I know the webinar participants are mostly LNG shipping companies, yet FSRU operations sometimes is closely related to the shipping side. Do you think that is a good market to step into as a complementary service for your customers? I'll force Karl first because he knows the space.
So Golar pioneered both FSRUs and FLNGs, and we were first movers into that business. And initially, it was an extremely attractive business. You could fix 20-year contracts as 4 to 5 times capex to EBITDA. Then you saw an inflation in number of players due to very strong economics, and the fact that most of the host countries understood that if they put the contracts out with longer lead times, there would be a more competition and then obviously lower return. That drove economics down to basically 10 times capex to EBITDA. Then we basically, prior to the Ukraine situation, had an oversupplied market. But because of the remarkable pickup, which we alluded to earlier in the conversation, of Europe going from 3 to 12 FSRUs, right now we have a tight FSRU market. So right now it's looking very interesting, but it's very finely balanced. So it is one where it's attractive, I'd say, to enter now, but you don't need too many to do that because until you're drastically overbuilt again. It only takes one FSRU too many to overbuild the market. It is a specialist market. It is as Jerry alluded to earlier, an enabler of a nation to very quickly become an LNG importer. Because it's significantly quicker to deploy than a land-based solution. So on the balance, it's more attractive now than it was pre the Ukraine situation because of the pickup of FSRU activity in Europe. I think that has proven that it's a good solution for many geographies, but it's one that should remain relatively specialized and not become a commodity like LNG carriers.
I know the carriers versus FSRUs are only tangential, but do you, Richard, Jerry, have anything to share on that?
Sure. It's the FSRU market is obviously a very interesting market, and while the asset very much looks like an LNG carrier, it's a very different asset. So stating the obvious, this is not a business where you could jump in overnight. There is also a number of infrastructure development elements in this business as opposed to LNG shipping, which is a more commoditized business. But I think also right now the big stumbling block remains shipyard capacity. Even if somebody wanted to look at the FSRU business, sourcing FSRU new builds is very difficult. There is only a very limited number of shipyards, predominantly South Korea, that can construct such vessels, and they will be at a very high price and with very late delivery. The other way would be, of course, conversion, but again, it's not necessarily a very cost-effective way, given also the lead time in terms of equipment. So it is definitely an interesting market. It does not necessarily mean that if you are in one that you can move to the other. But as far as we are concerned, at least, I think we have our hands full with taking delivery of another 11 LNG carriers for the moment.
Great. Richard, I have a capital allocation question directed specifically to you. We did mention the cost of new builds, the value of the underlying assets across the board. But the question is, why not, with the underlying NAV of your company, why not buy stock at a discount to NAV rather than pay the dividend?
It's clearly something that we'll consider when we next have this discussion. And the initial thinking was that we wanted to establish ourselves as a company that paid a reasonable dividend. We've now paid 4 dividends, so we've got a full year now, and that's being reflected on the information services, so people appreciate just what our dividend yield is. But clearly, going forward, we've got 2 ways to distribute surplus capital. One is by dividend, and one is by buybacks. And if the valuation is significantly below NAV, we'll most definitely consider the latter.
Okay, and I have one more global question, and then we can wrap it up. What do you foresee the effect of the LNG sector will be if a pro-energy president is elected in the U.S. in November?
Sorry, can you please repeat that?
Sure. What do you foresee the effect on the LNG sector would be if a pro-energy president is elected in the U.S. in November of 2024?
Okay, it's a fairly open question, but I think one of the key things that we look at when it comes to the US is that, as we explained earlier on in this call, the single largest incremental exporter of LNG in the world will be the US. Hence, what could be very sensitive is the US administration's view on those exports. If it is to put America first, then you could make the argument that it's better to keep energy prices lower in the US, reduce exports, and capture a lower energy price to fuel the American industrial market. But so in that context, it could curtail US LNG exports and therefore drive non-Henry Hub prices higher and Henry Hub lower. The other argument is that if you have an administration that wants to maximize or to do further incentives for gas exports, we could see even more US gas export projects coming. However, the lead time to build a project like that is 4 to 5 years. So whatever happens, unless there's a ban on export, it won't have any immediate effect. But it's really weighing, I think, domestic, basically the spread between Henry Hub, JKM, and TTF. So the administration's view on export is really what I would focus on.
Great, thank you, Karl. Richard, any final thoughts on the subject?
Yeah, I'd agree on how Karl framed that. I think my view is that the latter outcome is more likely, and that's because they'll prioritize the drilling of liquids, and there'll be associated gas, and that'll need to find a home, and its home will be LNG.
Great. That puts us at the top of the hour. Thank you for taking the time to join us today. Please note the webinar will soon be made available for access upon demand at Capital Link's webinar website at www.capitallinkwebinar.com and Capital Link's YouTube channel. I had to read that. I couldn't keep that to memory. Anyway, thank you so much. It was a very productive and informative hour, and I can't thank you again enough for your time.
Thank you, Liam.
Happy holidays, everybody.
Thanks for
Bye-bye.
Cheers, guys.